All right. This lecture module is called Bond Theory and Capital Flows. Bond Theory and Capital Flows. The point here is capital flows around the world around the world in secondary markets for stocks and bonds that have already been issued. In other words, they've already done their initial public offering, and then they're available in the secondary markets. These capital flows around the world. When I was Chief of Financial Oversight at the U.S. State Department in the year 2000, these capital flows were 1.5 trillion a day. I think today they're up to, in 2020, they're up to about 4 or 5 trillion a day, or 10 times the real goods and services money exchanges. And these capital flows, well, that's an example of the financialization of the economy, which we'll look at another time. But these capital flows are based on entrepreneurs seeking the highest returns in the capital markets. And a lot of this is in bonds, the form of bonds. So what I would like to look at is, share with you, is bond theory. So here's a graphic I put together to explain bond theory, which is available on my website. So you'll see bond ratings, and all of this idea is more theoretical than it once was, because everything changed with the 2007-2008 bailouts, where there's a lot more political capitalism as opposed to more free market capitalism. You have more political capitalism, so the risk rating of bonds are less important than they once were, because of how politically well connected you are really depends on how risky the investment is. So if you're politically well connected, then you're that may or may not necessarily be captured in the bond rating. So what I'd like to show, you'll see that I've got borrower, class, rating, and then time. So you've got the borrowers, and then the type of borrower, and then the rating, and then you'll see that the interest rate increases over time. The amount you have to pay if you're borrowing money increases over time. So for example, so over time, you have to pay more interest when you're borrowing money in the loanable funds market. And then the more risky you are, the more you have to pay if you're borrowing in the loanable funds market. So historically, whoever is the predominant hegemony, and until World War I, that was Britain, now it's the United States government can borrow. It's considered that's the risk-free class because they've got the power to tax. So it's considered a safe or risk-free bond. And historically, again, up until the 2007, 2008 bailouts, now, government bonds are near zero. But historically, you would pay uh, the predominant hegemony with the exorbitant privilege or the power to tax would pay 3% for a 30-year bond, and they would have the AAA rating. That's called a sovereign debt with the AAA rating. And then the next category down after the predominant hegemony U.S. government would be the European Union core countries, which are France, Germany, Netherlands, and they would have to pay a little bit more to borrow. And then you've got private classifications, blue chip stocks, Microsoft, Exxon, British BP, AAA rating, and because they've got long-term profitability and reputational capital, they pay less than, say, down here, Facebook, who I'm not sure if they're making a profit yet or not, but they don't really need to borrow because they don't need to borrow because they're so well capitalized. But so then the next category would be the mortgage-backed bonds. Fannie Mae and Freddie Mac are created by the U.S. government to guarantee housing mortgages in order to encourage people to have debt and then therefore not question the ruling class. So you've got these mortgage-backed bonds, which and guaranteed by Fannie Mae and Freddie Mac, and these are called Fannie Mae and Freddie Mac is a government-sponsored enterprise. So, but because the markets really were not sure how Fannie Mae and Freddie Mac would react if there was a crisis in the mortgage markets, it was slightly less than a risk-free rating. And so it's that's called a implicit government-backed, government-sponsored enterprise. And this says the Basel standards, and the Basel standards are the international banking standards, which all central banks and therefore regulatory policy requires member banks to follow. So the banks were encouraged to hold these government-backed bonds as reserves, which then led to the financial crisis, 2007, 2008. And then you have private mortgages, and they're backed up by good collateral because the bank can take back your home. And of course, there's a little bit more risk. And historically, prior to the financial crisis, a mortgage, a 30-year mortgage would be about 6%. And then you've got other sovereign loans, say the European Union periphery countries like Portugal, Ireland, Italy, Greece, and Spain. They have fiscal problems, so they have to pay a little bit more. And then a country like Mali, which has a lot of political instability, but does have the power to tax, has to pay 10% as opposed to 3% for the predominant hegemony. And then private companies, which haven't been in business long but have a lot of potential, then borrow at a certain percentage. And then say, for example, myself, I don't have any collateral, no reputation capital. So I would be a junk bond, and I would have to pay a lot to borrow money. So, so that would be capital flows. Then entrepreneurs then seek the highest return based on the risk return expectations, uncertainty, as capital flows go around the world. In this case, in bond investments. So that completes our lecture module on bond theory and capital flows.